I'm very pleased to welcome you to this tax and inequality panel. The purpose of this panel will be to discuss the role of tax systems in addressing inequalities and the types of tax policies that may be considered to reduce inequality, taking into account the specific circumstances of countries, but also potential policy trade-offs. So let me just start by introducing our three speakers today. We have Edward Abrokwa, who is a principal economist and head of tax policy research at the Ministry of Finance of Ghana. We have Alex Clem, who is chief of the Tax Policy Division 2 at the IMF's Fiscal Affairs Department. And we have Jose Troya, who is the former head of the Department for Large Taxpayers and International Taxation at the Internal Revenue Service of Ecuador. And he is also the coordinator of the UN Subcommittee on Wealth and Solidarity Taxes. So this panel is very timely, as we've been seeing increasing calls for action on taxation and inequality. The latest data from OECD countries shows that the wealthiest 10% own over half of total household wealth, while the top 1% own close to 20% of that total household wealth. This data also shows that the share of wealth held by the top 10% has increased in the last decade in 2/3 of OECD countries with available data. Likewise, the latest World Inequality Report shows an increase in global wealth inequality, with the share of household wealth held by the top 0.001% rising from 3.5% to 6.5% between 1995 and 2021. As we know, taxation is a key instrument along with other key policy tools that governments have at their disposal to address inequalities. And strengthening the role of tax systems in addressing inequalities would support progress towards meeting the UN Sustainable Development Goals, in particular, goal number 1 on ending poverty and goal number 10 on reducing inequalities. And with many countries looking for additional sources of revenue, in particular to meet long-term challenges like climate change or population aging, ensuring that everyone contributes their fair share has become even more important. The OECD has been doing a lot of work in this space, in the tax and inequality space, focusing in particular on the taxation of capital and capital income. And you may have seen some of our recent reports on the taxation of household savings, the taxation of inheritances, the taxation of wealth. Last year, we also released a paper that compares the tax treatment between labor and capital income across all OECD countries. So it's been a big area for us. We have also done some work looking at how tax systems can support more inclusive growth, and looking at how tax systems can also incentivize participation in the formal economy as well as female workforce participation. But we know that challenges vary very widely across countries, and more attention really needs to be paid to the specific challenges faced by developing and emerging countries, and that's the point of the discussion today. So for this session, I will be asking our panelists a series of questions about tax instruments that often explicitly aim at reducing inequalities, but we will also consider tax and transfer systems more broadly, because all taxes and transfers have distributional impacts that we should be concerned about. So question 1, discussions on the use of taxation to reduce inequality tend to focus a lot on personal income taxation. But a key difference between developed and developing countries is how little revenue is raised from personal income taxes in developing compared to developed countries. So according to OECD data, personal income tax accounts for about 1/4 of total tax revenues in developed countries, but less than 14% in developing countries. So could you give an overview of the factors that explain the limited role of personal income taxes in developing countries? And could you also talk about potential reforms and changes that could help enhance the role of PIT in developing and emerging economies? And so perhaps, Alex, you can start, and then we'll hear from Jose and Edward on this question. Thank you very much.
Yeah, thank you very much for the question, Sarah. There are many aspects to the answer. So to some extent, it is quite natural. If we think about people who have low incomes, they should not pay tax on the level that they earn for their own subsistence. So then if you think about countries where the average income level is much lower, then the subsistence part of that income is going to make up a greater share of it. So it's quite natural that less personal income tax can be collected in poorer countries. But that's not the whole story. That only explains part of the weak performance. And even when we look at high incomes, and high incomes exist also in poor countries, they are also often not taxed. And that is a problem because I think, as you said in the beginning, the income tax is one of the most progressive tools we have. So it's arguably the only tool we have to address inequality at the top, right? When we think of poverty, there are many ways we can address it. We can provide transfers, we can provide public goods. But if we care about inequality at the top, if we compare the top decile to the top percentile, there's not that much we can do through expenditure policy. We need to use tax. And if we want to raise more tax, one of the issues is policy, so tax policy. As long as we shield the poorest members of society by having a sufficiently large personal allowance, and I'm not saying that the current allowance is necessarily the right one. In some countries, it might be too high, but certainly it must be high enough to shield those earning subsistence levels or barely above that. But as long as we do that, we can raise other rates. And international comparisons suggest that also top rates tend to be relatively low, and the thresholds where they kick in, these top rates, are also relatively low in developing countries. So there is some room for raising them. Some countries might find it easier to collect corporate income tax, value-added tax, or if they have it, natural resource taxation. But even taking small steps toward strengthening the personal income tax would be really helpful for setting the basis for a future more progressive system. Let me mention that last September, we published a staff discussion note on building tax capacity in developing countries. And there we found that tax revenues could be boosted on average by 9% of GDP through tax and institutional reforms. Of course, not all of that is personal income tax. It includes all taxes. And not all of this is policy. It includes better enforcement and so on. But it does give you an indication of the order of magnitude of additional revenue that we could obtain in these countries. Now, I talked about policy, but let me briefly talk also about enforcement. In some developing countries, personal income tax is really paid only by civil servants and the employees of large companies, while the self-employed, which often include doctors, lawyers, architects, and so on, they are not contributing, even when they are doing well. So their enforcement is key. Nobody wants to pay tax when they are the only one, and they know that everybody else is not paying. So enforcing it really helps reduce resistance to paying this tax. Informality is another important issue. I think we should come back to that later. And then let me just briefly mention one other aspect, which is that it's very important also to make good use of the revenues. Because if we have visible public goods or notable reductions in poverty, that improves morale of taxpayers because they see that the tax they pay is not pointless. And sometimes it could even be that tax revenues are already used well, but because there is no transparency, people don't notice it. So it's also really important to share information both on the revenue and on the spending side, which brings me to my final point, which is that you need a strong institutional framework. So that's really the starting point for ensuring that tax reform is good. You either set up or strengthen a tax policy unit that can develop the ability to analyze taxes, forecast revenues, assess risks, and publish key results, because that can then be the key input to improving domestic policy. So that's it for now. Of course, happy to come back on any of these points later. Thank you.
Thank you very much, Alex. Jose, please.
Thank you, thank you. And I have to agree with most of what Alexander said. I think that inequality itself explains this phenomenon. So from a large low-income population, a small tax base follows. So measures to address inequality in general would, in general, also achieve a better role for personal income tax. And this is some sort of, for my point of view, a chicken egg situation where, of course, measures to reduce inequality may enhance the role of personal income tax, and personal income tax also addresses inequality. Um, so those broader policies that I think we are going to talk about, some of them will be key for this. Also, tax evasion and avoidance, of course, in developing countries are exacerbated by weak enforcement measures, corruption, and the overall compliance culture of a country. So yeah, you can have policies like GARS, that is general anti-avoidance rules, or specific anti-avoidance rules, which should be enforced by strengthened authorities. One thing that I would add from what Alexander said is international cooperation. I think that the current international cooperation environment, where most of the world is already involved, especially on transparency and exchange of information, provide a special opportunity for developing countries so that they can better enforce their laws and enforce anti-abuse treaty provisions if they have those. So this is an important tool to reduce personal income tax evasion and avoidance. However, I think that more cooperation would be helpful, even more, especially in the area of tax collection. Yeah, I think that coming to the compliance culture, maybe countries and not only tax administrations, but also legislators, taxpayers, and tax advisors need to improve their knowledge, for example, not only in tax matters, but also, for example, in IT, to reduce compliance costs. So there is a matter of efficiency of the overall tax system. Also, something that Alexander mentioned, I think that historically there has been a paradigm with for developing countries to raise revenues basically on indirect taxes, VAT, and so on. And that is changing, but it's still there. So I think that this paradigm change should be kept and strengthened. Finally, I think that also Alexander mentioned this, but I think in general that the governance framework of countries, the institutional framework of countries should be strengthened, and taking into account that in developing countries, high net worth individuals are commonly politicians themselves or closely related to them. So institutional framework is key. And that would be, of course, the use of information, international shared information, I think is also key to address the top of the wealth distribution in countries. And that's for me. Thank you very much.
Thank you very much, Jose. Edward, anything to add on the role of PIT and how to strengthen it in developing countries?
Yeah, thank you very much. I think that most of the technical arguments have been made by Alex and Jose. So maybe one of the interesting things I can do is to add some color to the discussion around PIT and the challenges of PIT from a developing country perspective, right? So from the point of view of Ghana, I'll give you some very interesting statistics. PIT is only 15% of total tax revenue in Ghana. And basically the question from a practical sense is what's really accounting for this kind of low relative collection from the total tax system. Informality, as Alex has touched on, is key, but most of the things that you find from the informal part of the business is actually to do with self-employed. And you'd be surprised to know that within that informal, the use of the broad language informal, there's the professional side of the informal. So there are certain professions who have actually automatically kind of moved themselves into some kind of the untaxed informal bracket as well. So for instance, in Ghana, one of our key challenges is lawyers. We have over 60,000 professionals that are not actually on the GRA, on the Ghana Revenue Authority system. So clearly you can see from the point of view of Ghana, the challenges practically, apart from the informal argument, is also record keeping from the self-employed angle. You clearly would see that it's very difficult for self-employed people to actually keep good records of businesses. And if you superimpose that on the need for the tax system to sort of put in place certain clear processes to file your taxes, for instance, you must have an audited account, etc. These tend to become very onerous for basically people who are self-employed or people who are within the informal sector. So if you look at the GRA numbers, it's actually quite startling. 3 million people registered for PIT, only 2.4 million, as Alex pointed out, actually are from the formal employment sector. So basically, these are PAYE paying people. Only 600,000 people are from the self-employed side. And this is on the back of a 12.9 million population of active people in employment. So these are really big challenges. Of course, you can also make the case that income in general is very low in most of these countries, so it narrows the tax base as well. So that can affect the collection. But ways to enhance, just ways to enhance it from a practical sense. Basically, from Ghana's point of view, it's basically to simplify our tax administration, to make it easy for people to file, and to make it easy for people to actually go around keeping records. So maybe one of the ways that the tax administration could actually address some of these things would be to use the administrative system to segregate the self-employed side, right? So you have people who are in proper formal employment, but that not just they cannot be identified. So that is one aspect of it. Another aspect would be to kind of harness digitization, because we have seen a lot of the growth in digitization in the economy, but we need to be able to use that to identify taxpayers. If a taxpayer cannot be identified, they're not likely to be willing to pay taxes. So these are some of the broad things that we're doing. But the one thing that we've also tried to do is to target the informal, or to target the population as a whole, the high income groups, using what we call a high net worth program in the tax administration system, which is basically geared towards targeting certain people in the economy and actually going after them to actually be able to raise more revenue from the PIT side. Of course, you can, as Jose made the argument, you can connect the argument around governance and transparency as well. So, I mean, broadly, this would be my initial remarks on this particular issue. Thank you.
Thank you very much, Edward. And you started answering the second question. Of course, there's overlap between the first question and the second question, which was really focused on informality, but I think it's good that you brought these two issues together. And you started, and just to say, informality is, of course, a major issue for developing and emerging countries in particular. And it's an issue from different perspectives, from an efficiency perspective, from an equity perspective, from a revenue raising perspective, and ultimately it constrains the ability of tax and transfer systems to reduce inequalities. And so you started answering the question about ways in which developing countries can use tax systems to encourage participation in the formal sector. I was wondering if you could add a bit more on this. And perhaps one of the things that we've looked at the OECD is the use of simplified regimes, like presumptive regimes. Perhaps you could say something about that and whether you think those are good tools to be increasing incentives to participate in the formal sector. And perhaps also a sort of sub-question is whether you think in the short run, there might be a trade-off between wanting to encourage formalization, participation in the formal sector, and on the other hand, reducing inequality. And if you think that in the short run, there might be a trade-off between these two objectives, again, the question from a tax policy perspective is there anything we can do with designing measures in a way that we can balance this short-term trade-off between perhaps encouraging formalization and reducing inequality? So the floor is yours, Edward, and then we'll hear from Alex and Jose.
Right, thank you very much. I think you're right in saying that the use of presumptive tax systems are also equally important. This again, from the point of view of Ghana, it would be one of the things that is being used at the very lower level, where most of the Ghana Revenue Authority staff go down to the very informal part of the economy, and because records are not available, a flat rate is actually applied kind of under the presumptive tax regime systems. But I think that to sort of zoom in a little bit more on the discussions around how to kind of increase participation in the formal economy using the tax system, we've touched on the issue of using technology, but also one of the key things that we need to also bear in mind is compliance. The compliance cost for people to actually come into the tax system, as was mentioned, as I mentioned earlier, but also to kind of also look at aspects of, again, harnessing certain technological improvements. For instance, in Ghana, we've gone to the extent of actually creating an online tax system where a taxpayer can actually go online and follow a very simplified process to actually file their tax. And the system can then help you automatically estimate your tax liability. And then the system itself can then help you to actually online make payments. So this, again, it's also quite useful. The system is called the iTabs. And also there are businesses, and I think the informality argument for me is always very interesting, because there are businesses that may be formal businesses that are also not actually formally registered. So I'm not sure how we kind of push them into the discussion, but you can have a relatively formalized business that is not actually working. So in Ghana, one of the things that we tend to do is we try and use issues around granting tax amnesty, where certain penalties are waived for people to formally register with the tax authority and become tax-paying entities. But if you want to really take it beyond, if you want to look at the argument around trying to formalize the informal sector, I think one then needs to probably expand the argument towards a broader macroeconomic discussion, where you're looking at improvement to access to financing, because part of the reason why people are more informal is actually because they are operating under very smaller settings, kind of like under usual mom and pop shop operations. Where, so if some kind of broader macroeconomic reform is undertaken to actually provide microcredit, etc., to some of these people, you could actually see some of them actually move in. You could also look at things around labor market reforms, for instance. One of the challenges in the informal sector is also to do with the fact that labor standards are not properly adhered to. Certain benefits that are due people in that space, for instance, in terms of national insurance contributions, which is our traditional pensions, national pension scheme, they don't actually contribute to these schemes, and you have the knock-on effect of some sort of social dislocation when these people actually get to a certain point in their lifestyle and they don't actually get pension to draw on. So some of these measures where the government can then kind of embark on strong labor market reforms, which then forces some of these standards to be implemented, would automatically kind of push people into that kind of system. Obviously, when you look at these things, like you're saying, what are some of the trade-offs? Of course, once you formalize things, naturally, I would expect, at least in the short term, to be some kind of dislocation in terms of employment, right? So, salaries may probably have to go up a little bit, certain things would need to happen. And then, of course, from an equity perspective, people who are probably at the lower end, the unemployment levels at the lower end of the stick may probably jump, maybe marginally initially, and then you can hope that these things would kind of adjust. But of course, for them to adjust, maybe the government then would have to kind of maybe embark on some sort of very structured skills training, etc., to move people along the line in terms of upskilling people to be able to earn certain levels of income. But the last bit really for me would be to look at the challenge of actually using targeted social spending, which is also, again, a big problem for most developing countries, because targeting in itself is a challenge. But you could, I would say, in Ghana, for instance, the idea would always to use what we call an indirect targeted approach, where maybe government is subsidizing certain public sector activities like education, and medical, transportation, etc. And this would be really relative to specific to maybe just the state provided services. So for instance, if you're going to take the state provided transport, you get a subsidized transport. If you're going to go private, you pay the private market price, etc. If you're going to go to a state school, you pay a subsidized fee. And then, because these things, for me, clearly, if it is done properly, does not distort the underlying economic incentives of people. Because if you're rich in this part of the world, you're not likely to use the public sector services anyway. However, if you're using the private sector and we're taxing you and we're able to make those transfers to the other system, there's some sort of balance over there. So I'd probably want to leave it here and then maybe allow Alex and Jose to come in on this as well. Thank you.
Yes, please, Jose, Alex, come in.
Thank you. I'm happy to come in. I'd like to expand on one of the points that Edward made, which is that it's not just about tax, and emphasize that this is correct. So if people make very low incomes, I mean, they shouldn't be paying tax under most systems because of the personal allowance. So if they don't formalize, it's not because they don't want to pay tax or can't afford the tax, unless the tax system is badly designed. And if the tax system is well designed, there's also no problem of rising inequality because people formalize. So the issues then are labor laws, licensing, social security, whatever the case might be. And in that context, we have to be very careful with presumptive taxes. Presumptive taxes are great if they are approximately at the correct level and they just simplify everybody's life. But they are a problem if poor people suddenly have to pay presumptive taxes while their incomes are so low that they shouldn't really based on their income. Equally, they are a problem if they are so low that rich people use presumptive taxes and kind of treat it almost as a tax incentive and pay less. Of course, that's tricky to do. Therefore, I'll leave it at that.
Thank you. I may also add to what Edward said, that sometimes we think that informality is only on low-income potential taxpayers, because we are not taxpayers yet. But I think that in my experience, you have large informality also involved with formality, and not only maybe with the professionals, but also even with big companies that may not invoice all their sales, for example. And I think that in a way, if you target those big fish, so to say, you may address at the same time inequality and informality. And maybe another measure that we had experienced in Ecuador is improved financial formalization. There's many ways to increase the use of financial services by the population, but we had a tax measure that it had a threshold for deductibility. So above a certain level, all the transaction, all the expense should be performed through the formal banking sector. So that may be a way to address this with a tax policy measure. What else could I say? I think that I agree with Alexander that simplified tax regimes should be carefully introduced, and because you may have these inequality issues. So the lower income taxpayer to pay more. It introduces maybe simplicity for that segment that is the system addressed to, but sometimes it introduced more complexity in the overall system, and that happened to us, and those systems were abused, and I think are still abused in Ecuador. And I think that's what I could say for now. Thank you.
Thank you very much to the three of you. I think an interesting message from all of this is the many faces of informality. I think we may have a vision of what it's like, but there are many forms. And you were saying that there's also informality at higher income levels, you know, including with professionals, for example, and targeting informality there might also there might be good alignment with inequality reducing objectives. But this is an important point about these different forms of informality. And I think you also all raised interesting points regarding the potential risks associated with presumptive tax regimes, and so the importance, if they're going to be used, of designing them very carefully. So I think this was very helpful. Now for the next question, I would like us to shift our focus to a topic that has attracted a lot of attention in discussions about taxation and inequality recently, which is wealth taxes. So what are, I mean, I'm interested in hearing your views on the use of wealth taxes, specifically in a developing or emerging country context. And I'm interested as well in your views about how wealth taxes compare to alternative tax policy instruments aimed at taxing those at the top of the distribution. So for this question, it'd be great, Jose, if you could start and focus on the first part of the question on your views on a wealth tax in developing or emerging country context. And then Alex, you could focus more on the second part of the question on comparing wealth taxes with other tax policy instruments. And then Edward, you can come in and add your thoughts to the discussion.
Sorry, there are different types of taxes related to wealth, and that is something that we identified in our subcommittee. And I'm going to focus, and the work that we have been focusing on is on net wealth taxation, especially for individuals. But I think that in general, this is one more tool. So the relation with this other taxation related to wealth, for me, is that it should be a tool, and I personally would recommend developing countries in general introducing net wealth taxation, even if sometimes it could be turned off, or other times include surcharges, because I think it's a useful tool for special circumstances. In a way, for extreme circumstances, I would say. For example, if there are really high commodity prices, or if the country, there is an earthquake in the country, these taxes could be useful for a more equitable share of that windfall wealth increase or decrease in the overall economy that are generated by those extreme circumstances. I think that for those circumstances, and in general, wealth taxation gives message to the public, to the taxpayers, to improve the trust in the tax system, that those equality objectives are better targeted by those type of taxes. In a way, I think that personal income taxes also could correct possible loopholes in other taxes, especially in personal income taxes. It should not be the main objective, but in a way could be useful for such purpose. I think I know that the revenue that could be this type of taxes could collect could be low or relatively low, but for those other purposes, I think that those are enough reasons. But you should also, of course, take into account the revenue purposes, and at least partially reduce the pressure on increasing less progressive taxes, especially if you have those type of prices, for example. Also, an advantage is of net wealth taxation is to improve more productive use of assets, and in a way reduce speculation, which is something that also or implies economic rents or more inequality in a way. for the people that can invest or use assets only for speculation. But of course, there is some cautions. I think I would give, and it could also be checked in the report that in the UN we are hopefully approving next session next week, and those are first to carefully introduction of exemptions, for example, or other preferential treatments. Be aware of what anti-avoidance rules should be introduced, including exit taxes. Exit taxes are those taxes that if a resident in a country then leaves the country, and that could be a way to avoid wealth taxation. So exit taxes could address that situation. Very careful with valuation mechanisms. They should be fair and simple, but it's easy to say that evaluation could be fair and simple at the same time. Tax policymakers always think that there is a trade-off, and I think it's real that if you want more fairness, you will have less simplicity, and the other way around as well. If you want more simplicity, fairness could be affected. But I think that you should be practical, so maybe more on the simple side, but trying to introduce the valuation techniques that with IT developments that we have now could be also fairer. Of course, avoid double taxation if countries have these taxes, and normally this worldwide criteria would apply also to wealth taxation. So residents would be charged on assets that they hold within their country and also abroad, overseas. And if two countries have the same criteria, you have this phenomenon, double taxation. So that should be addressed. And I think that in a flexible rate, as I said before, I think that as a practical tool, you may even turn off the tax if you think that is affecting, for example, your investment environment of a country, or the possibility of decrease the rate. So maybe within a range, governments should be able to introduce flexible rates, and also progressive, of course, rates, and to introduce also, for example, surcharges, as I said in the beginning, for crisis, earthquakes, and situations like those. All of those, I think, is because in those situations, I think that also is important that the more wealthy, or the taxpayers, the higher income and higher wealth part of the population can support a bigger burden of that situation. And in the right side as well, of course, especially as I said before, for example, if there are very high prices of some commodities and those type of situations. I think that would be it for now. Thank you very much.
Alex?
Yeah, thank you. So we have just published a note last Friday on how to tax wealth, and I saw Abrams already mentioned in the chat, so thanks very much for doing that. Let me start by making this general statement here about should we tax wealthy people, right? So I think there's no technical answer to how much we should tax the incomes of wealthy people or their wealth. And different countries will have different preferences, and there are certainly equity and efficiency trade-offs. But whatever vision you have as a country, it must be enforced. So if the richest don't pay their tax because they make use of loopholes or they evade, then the intention of the tax system is not achieved. because then the tax system becomes regressive at the top, and the other upper middle class, they pay then far higher tax than the truly wealthy. So that clearly is something that cannot be optimal. And while there is no technical answer on this question of how much to tax, economics can tell us a lot about how to tax, and that gets at the heart of your question. And here, I think, as in many areas of economics or life, the simplest answer is not necessarily the best. So specifically, just because we might be concerned about wealth inequality, it does not necessarily follow that we need to tax directly the wealth. Let's first approach this from an equity perspective. So a wealth tax is the same tax for people with the same amount of wealth, whether they earn a high or a low return. But we know that the wealthiest, they structurally tend to earn higher returns because they have better access to advice and so on. So if we tax their returns rather than their wealth stocks, we can actually have a more equitable tax system overall. Second, let's consider it from an efficiency perspective. A wealth tax, even though it's not described like that, it is the same as a tax on an assumed fixed rate of return. So that means that anybody who invests and makes a very high return, say, including a supernormal return, an economic rent, that person would be untaxed on that supernormal return, on that rent. And the only part that is taxed is some fixed return, which could be the normal return or some other fixed return. And efficiency considerations, they would call exactly for the opposite. They would say that, well, we should not tax normal returns so much because they are relevant to saving and investment decisions. But if there are economic rents, we can go after them because taxing them is non-distortionary. So the upshot of these equity and efficiency considerations would be that in most cases, and let me stress in most cases, not in every case, in most cases, it would be better to fix capital income taxes rather than to go for a tax on net wealth stocks. And we can fix capital income taxes by removing loopholes that might exist in the law for certain types of income. In many countries, a main preference exists for capital gains. So capital gains in most countries are taxed only when realized, which is already a tax advantage. But in some countries, on top of that, they also have a reduced tax rate, which increases the advantage further. And if we look at data, we see that the wealthiest people often receive a significant share of their income in terms of capital gains. Now, if we can address this directly, then we do not need to think about wealth taxes. But of course, it might be difficult in some contexts, and then wealth tax would be some way of getting around that. I don't have time here, but let me just mention that the note, we also go into wealth taxes just for the super rich, which is a little bit different in terms of its impact. And we also talk about capital levies, which are kind of one-off wealth taxes. And Jose mentioned those in response to disaster or something like that. Let me just conclude, because I mentioned now capital income taxes and I mentioned taxes on wealth stock, but there's a third important component, and that's taxes on wealth transfers, namely inheritances, gifts, bequests. So they can be a really useful complement to the other taxes because they are relatively efficient ways of raising revenues, and because they address the build-up of intergenerational wealth within families, that can stay over centuries. So a combination of those is usually a good idea. Happy to follow up on any of these points. Thank you.
Edward, do you have anything to add on wealth taxes?
Yes, just quickly, I think it's interesting because the argument has also been kind of distilled into, I think Jose touched on this, the social justice arguments around, generally the wealthier must pay more. And then of course, Alex has come in very strongly with the economic arguments around, the economic efficiency arguments and taxing normal rates of return versus economic returns. The big thing for the practical aspect of, from my point of view, I think that I kind of lean towards Alex's position in terms of the economic arguments, obviously. But what you tend to also see, and quickly, would be that you tend to see that the practical aspect of actually implementing a wealth tax is it's an additional layer to what is already a very complicated tax system in a developing country context. So, for instance, you're introducing new challenges in terms of whether the tax can be robust from the avoidance point of view. Would the tax even be robust to avoidance? And of course, you're taxing the wealthiest people in an economy who have all the resources to actually avoid the very tax that you're trying to implement. In terms of even administering it, does the local revenue authority itself have that capacity to actually really add on this additional layer to actually tax? So my view has always been that we should, and I think that's what Alex again touched on, we should actually focus on the sources of wealth and try and tax those sources of wealth very well. So if we actually can do that, then we're honing in on indirectly also building a more efficient, a more equitable tax system, a more progressive tax system as well. The tendency, the political economy tendency of actually zooming in on wealth and the wealthiest must pay more seems very attractive, but then when you go into the economics and the practical administrative aspect of it, it tends to be a little bit challenging from a developing country point of view. So I know we are running a bit behind time, so I would leave it here, and then so we can actually move on to other questions as well. Thank you.
Yes, thank you very much. And I also have many follow-up questions on wealth taxes, but I will have to restrain myself and move on to the next question. But this was very interesting. Thank you very much. So we have talked about, and again, this I think was a good summary of sort of some of the pros and cons of wealth taxes, and so I think it was a very helpful discussion. But we've talked about a lot of different tax policy instruments. So we've talked about PIT, we've talked about wealth taxes and other taxes on capital. And we often talk about specific tax instruments separately. But ultimately, it's really the overall impact of tax and transfer systems that matters. So what can we say about the overall distributional impacts of tax systems in developing countries, and about the effectiveness of transfer systems as well in addressing inequalities? And from an inequality reduction perspective, is there also a need for better coordination between tax and spending policies? And Edward, please, it'd be great if you could take the lead on this question, and then we'll hear briefly from Alex and Jose if they have points to add.
Great, sorry, I will try to be very quick so we can actually get everyone's views in. It's a very delicate question you ask about looking at the tax system as a whole. I mean, for a practitioner or an economist, that is always the default. You want to look at the tax system as a whole, because what you don't want to do is you don't want to zoom in on particular tax handles and actually then check and say, oh, is this very good for the system? If the entire tax system is progressive, this is really what you want from an economist point of view. But I'm afraid when I sit in a ministry and we're doing analysis, basically, it's almost done on a tax handle by tax handle basis, right? So there's a big debate recently in Ghana about VAT, for instance, and it's actually very interesting. You think about VAT, and if you follow through on some of the basic arguments around VAT, it's actually very shocking because, for instance, in a country like Ghana, VAT is on goods and services beyond a certain threshold for suppliers, right? And guess who goes to those areas where these goods are supplied? Is the rich. You would go to the standard shop, you would go to all these other places. However, try increasing VAT on certain things and you have a resistance. So what I want to say is that the argument around looking at the tax system as a whole is also kind of driven also sometimes by the discussions around the obsession, I would say, around looking at specific tax handles and actually trying to zoom in on them. We did some very interesting work out of curiosity in Ghana with Institute for Fiscal Studies in the UK about just looking at the entire tax system in Ghana. And we actually found out that contrary to what the general expectation is, that broadly speaking, our tax system is a little bit progressive. I was shocked. I was not, okay, I would say I was not necessarily very shocked, but it shocked a lot of people within the policy space, because then the general feedback that you get is that this system is actually very, very regressive and people are suffering and it's not helping, etc. The problem in most developing countries also is that you need to then say that you need to connect, as you were rightly making the case, you need to connect the collection of the taxes with the spending of the taxes, and potentially with the building of a tax and transfer system that would kind of make sense to everyone. Unfortunately, for most developing countries, what you would see in practical sense would be a system whereby we have challenges in identifying the lower income groups, and therefore making direct transfers to these groups tend to be very challenging. So what you would then fall on is, as I made mention earlier on, to do some kind of reverse engineering by doing some kind of targeted, broader public spending. Of course, then that runs into challenges also around, whether the quality of spending is actually where the levels at which it should actually be. Again, when people feel that, maybe the tax system itself, even if it's progressive, if the revenue itself is not being used in a very efficient manner, it also then raises questions about the efficacy of the tax system as a whole, because then people begin to question whether the willingness to actually be part of the tax system and pay taxes that is due, it becomes very challenging. The knock-on effect being that it affects the tax administration as well. What I would want to kind of say is that there's absolutely no question in summing up that it's a very difficult thing to say, but it is an important point to make, that the quality of government spending must correspond to the revenues that is being raised. If government is seen as basically not spending the revenues appropriately, the little tax revenue that it raises appropriately, the knock-on effect, it has a feedback loop to what is being collected at the moment and the ability to even collect more in the future. I want to leave it here and then allow my colleagues to also come in. Thank you.
Go ahead, Alex and Jose, if you have anything to add.
Thanks. Just very briefly, fully agree with what Edward says. And just to mention, yes, it's not just one tax you can focus on. You need to focus on all, but also you need to focus on the social security contributions. And the combined schedule is often very erratic and unlikely to be optimal under any theory, if you look at it. And then if you really want to take it seriously, you go further than that, because there's often public spending that depends on incomes, maybe free school meals, reduced price of public transportation. It's going to be different in every country. But ultimately, for assessing progressivity, you need to take all of these things into account, as well as for assessing the incentive to improve your income. You need to also take the loss of all of these benefits into account. So absolutely, I agree on this. Thank you.
Just very briefly as well, I think I would add that for a tax and tax management perspective in a country that includes policy and also administration, I think that these initiatives of introducing high net worth individual units are very interesting, and I would support that unit. It doesn't matter what taxes you have, but in a way, it studies the behavior, and not only the evasion and avoidance practices, but also where the high net worth individuals stand, what are their income, the sources of the income, and what could be done. And then I would not rule out any measure, for example, personal income taxes, VAT, or wealth taxation. Thank you.
Thank you very much. So for the last question of this session, I wanted to step away a bit from the purely domestic focus and ask the three of you whether there are areas where you see a need for increased coordination across countries when it comes to taxation and inequality, and perhaps more specifically when it comes to the taxation of high net worth individuals. And Jose started mentioning that in response to the first question, but just very quickly, very brief answers to just get your views on whether you think there's a need for increased cooperation between countries on this topic.
Thank you. Yeah, as I said before, maybe just to emphasize that I think that on top of exchange of information, I think that the tax collection, cooperation in tax collection is very interesting. If that could be improved, because many countries still are not implementing that, and it's something that for many developing countries is new. But I think it's an area that could be very interesting for tackling these issues. Thank you.
Yeah, I fully agree with Jose. Strengthening exchange of information is key. A lot has been achieved, but there's still some blind spots. I think real estate, for example, there is no exchange of information on who owns real estate and things like that. And those assets that are not covered should be part of it. And then, because your question also hinted a bit at what comes into the future, I think one aspect about which to be really vigilant about is schemes like citizenship by investment, because they allow people to circumvent exchange of information. I don't have the answer, but that is definitely an area on which to be vigilant. Thank you.
Thank you. And I think I agree with Jose and Alex. The only additional point I would also kind of make around the key aspect of actually exchanging information, especially when it comes to high net worth individuals, would be that sometimes from the practical sense, what you tend to see is that information is sent between, let's say, Ghana and the UK, and then the information comes back in a form that is almost not usable. So there's a sense that as much as we want to exchange information, there's some sense of kind of trying to standardize and harmonize how this information is shared so that it's actually very useful. And of course, one needs to build a local capacity as well to actually mine some of the data that you receive from some of these processes. But definitely agree with Jose and Alex that exchange of information is actually very critical to addressing this challenge. Thank you very much.
Thank you very much. I think this brings us to the end of this panel session. I think we've covered a lot of ground in terms of tax instruments that can help reduce income and wealth gaps. What we tend to see is that we need a mix of instruments. There's definitely no silver bullet. We need a combination of tax tools and to look at how they interact with each other, but not just tax tools, obviously tax and transfer systems, and also other types of policies, education policies, labor market policies. You all made the point about good governance as well. So it's all of this together. Taking into account as well the importance of policy trade-offs, and I think that's the challenge always in tax policy is looking at the trade-offs of different options, and we had a good example of that when we were discussing wealth taxes, for example. So with that, I just want to thank our three panelists very much for a great discussion, and also thank everyone online for attending this session.